joining us on this Thursday for our Instagram Live every 2 weeks. Max and Elijah telling you about the investment opportunities as well as our track record and all sorts of things real estate related at the Goldfinger Group. Today we're going to be talking about a case study of an apartment building that we purchased, renovated, and then sold in the Koreatown submarket of Los Angeles. And Max will tell you all about it, and I'll be here sipping some soda.
Enjoying the Santa Monica sun, right?
Yeah, exactly.
Is that how it goes? So this is a project that we bought back in 2016. I think we sold it, was it 2018?
Sounds about right.
So you actually bought it before I joined the Goldfinger Group, because I joined in 2018. And I remember when I joined was right at the time that we were in the process of selling the property, opening up escrow. So you definitely have a better understanding, but obviously I was kind of in the midst of when I was learning what the Goldfinger Group does and how Elijah operates. I was getting a better understanding through this project. So I was able to kind of use this as my case study to understand Los Angeles real estate and specifically how TDG invests in properties.
Right, so you were kind of looking at it from the bird's eye view, not really understanding everything that we were doing in real estate at the time. I still don't either. But you were kind of seeing it from more of a third party bird's eye view, kind of just getting into real estate. And I was actually involved in the transaction, having sourced the property, finding the property from a listing. The broker was listing it out of Orange County, so he wasn't really familiar with Los Angeles, rent control, etc., with the intricacies of the submarket that we were buying it in. And he was having a tough time selling it because initially they priced the property a bit higher than what it was worth. They priced it at just over $1,550,000, and we ended up purchasing it for $1,375,000. Which was probably around where the market was. Maybe we got a little bit of a bargain on the purchase, but we purchased it in line with the marketplace, in line with the comps. We ended up putting in additional funds to renovate the property and to stabilize it. But the real reason we were attracted to it is because we saw that we were able to almost double the value of the property. The income was very low, and we saw the potential to rent out the units at market by renovating, styling the building, and adding value, again, by renovating the property. And then putting in a leasing agent who had a good understanding of the submarket, was leasing a lot in the area, and gave us some ideas on how to push the rents. And that was the business model, and thankfully we achieved some good results for our investors.
Definitely, yeah. It was bought, I think it was like close to $200 a foot, which today it would be almost impossible to find something like that. But it says, where the market was at in 2016. The gross income was $100,000, and we saw the potential for it to be close to, over $200,000, like 210, 220. And based on that, we said, hey, look, the property is probably worth fully stabilized, units rented at market, decking out the units somewhere around 2.6. So we saw the value. If you've seen our other, webinars, we've talked about how we establish value, how we buy, where we buy, and why we buy. And so we saw this, ability to force appreciation by getting the income up almost double what it was where we bought it. And like Elijah said, what we see is, what is the area, what's going to be the future tenant base, and so let's renovate for that tenant base. And we did a really great job, at least you did, I wasn't part of it, fixing up the bathrooms. There was really cool finishes, the subway tile.
Great toilets. Those toilets are terrific. I'll never forget those toilets. Amazing. Golden, beautiful.
Exactly, yeah. Heated.
The way they flushed.
The sound.
Yes.
And so we renovated the property per the area and using really cool finishes that we're going to bring in a younger, hipper generation that, maybe were priced a little bit out of proper Koreatown, downtown, central part of Koreatown, but still wanted that proximity. It was also pretty close to downtown LA, so it's easy to get to. It was a very central location. And, when we sold it, we sold it. We ended up selling it for 2.4. Is that right?
Correct.
Which was a 12 GRM. So we bought it around a 14 GRM. Usually, when you're going to sell a stabilized property, there was still some upside. There was maybe 10 to 15% upside in the rents. But you typically sell it at a lower GRM because the next guy who's buying it is buying it for cash flow.
Right. Another thing that we saw when we walked the units, we did our physical inspection. We saw that 2 of the units that were 1 bedrooms. So I guess to backpedal, it was a 12-unit building. 8 units were studios, about 350, maybe 400 square feet approximately, nice size studios. And well, it's all relative to where you're coming from, but for this, part of Los Angeles to have a 400 square foot studio is really not bad. I actually lived in a 200. It actually, on the listing, it said it was 250 square feet. It was probably 150 square feet studio by the Grove, and I was personally very content there because it's very simple to maintain. You have a bedroom, a bathroom. I had a hot plate.
You don't even have a bedroom. You just have a bed and a toilet.
Well, you have a bathroom. I had a hot plate and a toaster and a mini fridge, and then I had a room. So that if you're living alone and you don't need much space, it's actually easier to maintain. So that was probably about 200 square feet. These studios were 100 times larger. They're 400 square feet, so massive studios. But all joking aside, we had 8 studios and then 4 1-bedroom units. So when I was talking about going through the physical inspection, we saw that 2 of the 1-bedrooms really had a second room that could be utilized by, let's say, 2 roommates that want to have 2 bedrooms. So while the listing said that they were 1 bedrooms, they were really operating as 2 bedrooms. So we were able to get about $150 more in rent for those 2 units, which over 2 units is $300, $3,600, $40,000-$50,000 in value creation that you would have never have known if you didn't go into the units and understood that you could get another $150 per month per unit. So those are some of the details of the transaction, and Max can continue telling you about the bathrooms because he really liked those.
But this is something that we do when we walk buildings, when we look to go under contract and we're doing our physical inspection, is finding ways to increase value, right? What can we add? What can we change? What type of renovation are we going to do? And this is another example of how we were able to execute that, see additional value that was not being utilized to increase the value on the back end, which is really going to help us in our margin and our profit for our investors and for our execution of the project. And we were talking a little bit about the sale, and so I think we sold pretty close to list price, right? I think we went to market at some 245, something around there.
2.5. We got into contract at 2.45, and they hit us down to 2.4. And at that time, we had found an exchange property that we really liked in Mar Vista. We still own it, and we were very excited about that. The prospect of buying that 10 units in a much better location with a huge amount of upside as well. So because of the fact that we had that upleg, that exchange already identified, we said, you know what, we'll give you that reduction, but you need to remove all the contingencies, you need to close. The buyer did that. They closed on the purchase. They got it at about a 6% cap rate, so they got a good yield on the purchase. Minimal upside, but still good yield. And they were happy with the sale, with the purchase. We were happy with the sale. We were able to take those funds from the sale and buy in a better location with more upside and overall a higher rate of appreciation because it's a better neighborhood.
Exactly, and I'll geek out on the numbers. I like the numbers. We'll use my Excel model. Sure. Elijah, pull out your napkin.
Yes.
So we bought it for 1,375. We, closing costs on the front end, which are loan origination, escrow fees, any legal fees, inspection, and that. We were probably, that brings us maybe to 1.4 and a quarter. We spent probably 600 grand on the building. 700 grand, would you say, in CapEx?
I don't think it was that much.
Okay.
Maybe
5.
Let me look at that napkin real quick.
Yeah, so let's say it was 500.
Yeah, 550 or so.
Yeah, so that brings us, let's call it 195. Another 70 grand in carry costs, sales costs on the back end. You got to pay the broker to sell it. You have escrow fees again. You have any legal accounting. So we were probably all in around 2.1. And so what we saw is a healthy profit to sell this and take it into our next project. So we kind of weigh that out, which we talked about in our, do we hold or do we sell? Well, this was an opportunity to make our investors a healthy profit and get into a better project that you were just describing. And if we look at it, we probably invested somewhere around, the equity that we had in the project was between 900 and $1 million. So, we made 300 grand on that over 17 months, which comes out to about 19% return for our investors on an annualized basis.
Yeah, and the equity requirement of 900 or $1 million, that was a lot. And at the time, we weren't able to qualify for a reasonable bridge loan, which now we're able to qualify for those. Our track record has proven itself that we know what we're doing. So the bridge lenders are happy to work with us. In fact, I think we're closing today.
We are.
On a bridge deal. So good work, Max, working on that deal for 2 years. Congratulations on getting it closed. That purchase, probably talk about that purchase in the future. And I guess what I was trying to say before I got sidetracked is that the equity of $900,000 for $1,375,000 purchase is a lot, and it's a lot more equity than we would have to put in if we were to buy a property today. And we'd probably put in somewhere, $600,000 or so, as opposed to the $900,000. But the reason that we put in the $900,000 to $1 million is because at the time we weren't able to qualify for a reasonable bridge loan. We could have gotten a hard money loan, but that would have been a much higher interest rate, and we just were not looking to take on such a high interest rate loan. So we ended up increasing the capital, the equity raise, I should say, and that's why our equity was so large relative to the purchase price. But fast forward a couple of years, the equity percentage relative to total cost of the project has definitely gone down for us.
Exactly, and this is all things that we account for when we're buying the building too, making sure that whatever is going to be reality. A lot of people look at deals, underwrite deals on what they anticipate, but not what reality might be. So we do a really good job in our due diligence process, even on the debt side and the equity side, aside from just the property itself and the value and the upside and the project and the business plan, but debt and equity, and making sure all our bases are covered.
Yeah, and if anyone has any questions about debt or equity and wants to see my napkins or his Excel spreadsheets, feel free to let us know. Max can run you through the Excel. I can send you a couple of my used napkins. And I want to also point out about this deal, we're talking about how great it was, how successful of a project it was, how happy we are that we did the deal. But I think more importantly than all that is, let's say it wouldn't have worked out. Where would we have been? Let's say we took on $1 million of our investor funds and we weren't able to execute our business plan. Where would we be? Well, we still would have had a asset that was cash flowing, a little bit of positive cash flow, probably not much.
It was probably like 4 or 5% cash on cash day one.
And then the 100% upside.
Yes.
So even if we weren't able to achieve our business plan, we would still have a cash flowing asset in a pretty good part of core Los Angeles. I'd say a B market of core Los Angeles, and still have all that upside on the property. So it's great that it worked out, but it's also important to think about, hey, what if it didn't work out? What if we weren't able to reposition the building? Where would we be today?
Absolutely. So that's it. That's it for our 12 units in K-Town that we did. We've now, the exchange property that we bought, we actually were able to do a similar business plan. We refinanced it 6-8 months ago, or maybe it was the end of 2019. So, now that was a property, maybe we'll discuss it another time, but we said, hey, like, this is something we probably want to own long-term, cash flow, we've repositioned and so forth, so.
Yeah, we're appreciative that you tune in for this Instagram Live. Again, if you have any questions, feel free to reach out to Max. I'm sure I'll be happy to talk to you. And so will I. But again, thanks for watching, and see you in 2 weeks.